Most people pay the IRS when they sell an asset. There's a federal program that lets you defer the gain, reduce it, and eliminate it entirely. And in 2026, it just got permanent. Did you know you can defer capital gains tax for 5 years just by reinvesting? And that after 10 years, every dollar of new appreciation can be completely tax-free? The One Big Beautiful Bill Act, signed into law in July 2025, made the Qualified Opportunity Zone program permanent, with new rules, new benefits, and a 30% step-up for rural investments. Today we are going to walk through exactly how opportunity zones work in 2026, the changes under the new law, and the strategy most CPAs are quietly recommending. This is real tax law, real money, and the rules are different from what they were 5 years ago. First, what an opportunity zone actually is. An opportunity zone is a federally designated low-income census tract. There are roughly 8,700 zones across the country, created by the Tax Cuts and Jobs Act in 2017, and as of 2026, made permanent by the One Big Beautiful Bill Act. If you sell an asset and have a capital gain, stocks, real estate, a business, anything, you can reinvest that gain into a qualified opportunity fund within 180 days. That fund then invests in projects or businesses inside an opportunity zone. Here's why that matters. You get 3 tax benefits stacked on top of each other. 1. Defer the original capital gain. 2. Reduce that gain by 10% or 30% for rural zones after 5 years. 3. Pay zero tax on any new appreciation if you hold the investment for 10 years or more. Run real numbers. Say you sell a property in 2027 for a $500,000 capital gain. Normally, you would owe roughly $120,000 in federal long-term capital gains tax. Instead, you reinvest the full $500,000 into a qualified opportunity fund within 180 days. Your tax bill on that gain gets deferred for 5 years. After 5 years, the gain is reduced by 10%. So you pay tax on $450,000 instead of $500,000. That's roughly $108,000 in tax, saving you $12,000. Now hold the investment for 10 years. Whatever your $500,000 grew into is sold tax-free. If it grew to $1 million, that extra $500,000 of appreciation owes zero federal capital gains tax. Now the rural angle most people miss. The One Big Beautiful Bill Act created a new category called Qualified Rural Opportunity Funds. These invest in zones with populations under 50,000. The basis step-up jumps from 10% to 30%. On that same $500,000 gain, a rural investment reduces the taxed amount to $350,000. Tax owed becomes about $84,000, saving you $36,000 off the original bill, before you even count the 10-year tax-free appreciation. And here's what's brand new in 2026. Under the original rules, the deferral period had a hard deadline of December 31st, 2026. That deadline is now eliminated. Investments made after December 31st, 2026 follow new rolling rules. 5-year deferral from the date of investment. Predictable. Permanent. That changes everything for 2027 and beyond. If you can time your gain recognition into 2027 or later, you get the new rolling deferral and avoid the December 2026 cliff entirely. CPAs nationwide are advising clients to delay non-time-sensitive gains into 2027, specifically because of this rule. If this is the kind of practical tax strategy you wish you had had earlier, please hit like and drop a comment below. I read every comment and reply personally. Share this with family and friends who need to see this. And don't forget to subscribe, because we put out several new videos every week. Drop a comment if you have a capital gain coming up and you didn't know this program existed. Real situations help everyone watching. Now let's talk about how to actually do this. Step 1. Identify your capital gain. Both short-term and long-term capital gains qualify. Stock sale, real estate sale, business sale, mutual fund distributions, crypto sale. Anything taxed as a capital gain federally. Ordinary income doesn't qualify. Step 2. Watch the 180-day clock. You have 180 days from the sale date to reinvest the gain into a qualified opportunity fund. Miss that window, and the deferral is gone forever. Pass-through entities like partnerships and S corporations get extra flexibility. They can choose to start the clock on the entity's tax year end instead of the sale date, giving you up to 15 months to plan. Step 3. Choose your fund type. There are 2 ways to invest: syndicated funds, institutional managers who handle compliance and asset selection. Most individual investors use this path, or self-certified funds. You create your own corporation or partnership, file Form 8996 annually, and meet the 90% asset test yourself. More work, more control. Step 4. Verify the zone designation. Opportunity zone tracts are listed publicly. The current map runs through 2028. New designations begin July 1st, 2026, with new zones effective January 1st, 2027. Verify any fund or project is actually located in a designated zone before investing. And here's what the One Big Beautiful Bill Act tightened. New zone eligibility now requires median income of 70% or less of statewide median, down from 80% under the old rules. Some current zones may not qualify under the new criteria when redesignation happens. So projects in older zones may face uncertainty after 2028. Now the 4 myths that confuse most people. Myth 1. It's only for real estate. False. The OBBBA expanded eligibility to include operating businesses inside opportunity zones, manufacturing, service businesses, tech, any qualifying trade or business that operates substantially within a zone. Myth 2. You need millions to participate. False. Many funds accept investments as low as $25,000. Some institutional funds have $100,000 minimums. Mid-6-figure capital gains can absolutely qualify. Myth 3. It's risky and unregulated. False. QOFS are regulated entities. They file annual returns with the IRS, the new OBBBA rules. Effective July 4, 2025, added enhanced annual reporting requirements with details on properties, employees, asset values, and investor activity. Myth 4. It's too late to benefit. False. The program is permanent now. Investments made in 2027 and beyond follow the new rolling rules. The benefits are arguably better under the OBBBA than they were before. All right, let's lock this in. Opportunity zones are now permanent under the One Big Beautiful Bill Act. Reinvest a capital gain into a qualified opportunity fund within 180 days. Defer for 5 years. Get a 10% basis step-up, or 30% for rural zones. Hold for 10 years and pay 0 federal capital gains tax on the new appreciation. Investments after December 2026 follow the new rolling deferral rules. Tax-free growth is capped at 30 years under the new law. New zone designations begin July 2026, effective January 2027. Real tax law, real money, real strategy for 2026 and beyond. If this video helped you, please give it a like and drop a comment below. I read every single comment and reply personally to your questions. Send this to family and friends who need to see this. And make sure you subscribe, because we put out several new videos every week. And the next video you should watch is our breakdown of revenue-based financing. The new SBA alternative that funds your business in under 48 hours. Make sure to subscribe so you don't miss it. It will be uploaded within the next 2 days. See you there.